Good afternoon and welcome to our UB Alumni Webinar Wednesday series. On behalf of the UB Alumni Association and the UB School of Management, we are delighted you are able to join us for today's presentation. My name is Christy Fields and I oversee the Alumni Career Services program here at UB. Today I am honored to introduce you to UB alumnus AJ Hitomi. AJ received his MBA from UB in 1994 and is the Chief Executive Officer responsible for leading Innovent Capital's business in India. In addition, AJ also serves as the Chief Operating Officer for Innovent Capital Group, where he has responsibility for developing strategy for the group, as well as setting up the group's business in new markets, which include Southeast Asia and China. He is considered to be a pioneer in starting the venture debt industry in India, which is a key global hub of innovation and venture capital. This webinar will not only talk about the concept of venture debt, but also how that works as a tool startups can use, along with venture capital, to access the funding they need to grow. Venture debt is an essential component of the venture ecosystem, and it benefits not only borrowers, but investors as well. We will leave some time at the end of today's webinar for Q&A with AJ. If you have any questions during the webinar, please submit them through the chat box on your screen. With that said, it's my pleasure to turn it over to AJ Hitomi.
Thank you, Christy, and hi everyone. This is Ajay, and I want to talk to you over the next half an hour, 40 minutes on venture debt. I'm glad we just have 40 minutes because I can speak about venture debt all day if I need to. So you have the screen in front of you, and I'm just going to go through a couple of slides to illustrate what we mean by venture debt. And I think the main thing is really to begin with the definition, and we'll get into it from there. And so venture debt is defined simply as any form of debt financing that's provided to a company that's still dependent on venture capital funding for its growth. And that's easy to say, but let's talk about what we mean by that. So this next slide here is really about the startup company lifecycle. And on the extreme left, you have a company that starts with a business plan idea. A founder wakes up in the morning with a business plan idea and then gets the first round of sort of informal funding from friends and family and angels. And that's the stage at which the company raises seed capital. And that could be anywhere from $50,000, $100,000 to a couple of $1 million. At that point, the company is still in the process of developing its product, its service offerings, and it's really at an R&D stage at that point. There could be one or a few people at the company at that stage, and really what the company is trying to do is to develop a prototype, which it can then take to the next stage. Once the prototype has been worked out, has been shown to work, potentially the next round is then the Series A, which is usually the term meant to indicate institutional capital, generally funded by venture capital firms. Typically, a Series A could be anywhere upwards of, let's say, $5 million. At that stage, the company then raises the Series A capital to develop its product further. And over the next course of the next few stages, essentially what the company does is that it hits certain milestones, and as it hits those milestones, it's able to raise further rounds of capital from institutional VCs, and that's through the Series B and the Series C and so on. And at each stage, the company gets a certain a quantum of capital. That quantum of capital is then utilized by the company to develop its business further and hit milestones as we just spoke about. Now, those milestones at the Series A, for example, could be bringing your first 15 clients on board, or selling your first 100 products, let's say, in the marketplace. It could be anything that the company and its investors decide is the next stage of evolution for the company. What's interesting also to note about the series is that as the series of the rounds of equity progress, the company's valuation hopefully improves and increases with every subsequent fundraise, and the quantum of capital that it is able to therefore raise also goes up through each round. So a Series A could be a $5 million round, a Series B could be a $20 million round, a Series C could be a $100 million round, and so on. And the advantage obviously is that as the company's valuations keep increasing, it's able to raise this larger and larger rounds of capital at better valuations, such that the existing investor and the founding team, do not dilute beyond a point. At a certain stage, the company hits profitability. The assumption in the slide being from seed capital stage through the growth stage, the company is essentially burning cash. It's not generating revenues to cover its operating expenses and its R&D expenses, and so it burns cash on a month-by-month basis. At a certain point in time, the company hits profitability, and from there on, you see the bottom green line, which is the cash line, essentially growing and moving to up and to the right. The red line, which is growth, is actually a line to describe the growth of the company's valuation. And therefore, as the company's products begin to kick in, as clients begin to accept the product, the company's valuations continue to rise. So you've got in the middle box there, you've got venture capital and private equity investors. The main sources of capital for growth, high growth companies as they scale through to raise funding from. And the next box there is the IPO market, or potentially a buyout market, where you could have either the company scaling through and going through an IPO, or being subsequently acquired through a secondary transaction. So where does venture debt come in? If you look at the right here, that's where most lenders tend to get comfortable with lending. These are because, this is obviously because companies at this stage have a certain critical mass of revenues, are profitable, have a track record and a history of growth and profitability, and lenders typically like to see these sorts of companies and are able to put up more traditional forms of debt capital to work in these companies. The venture debt space is to the left of that, and essentially it's venture debt plays in the space where companies are still growing, where they're still burning cash, but where importantly the companies have crossed into that middle box there, which is the institutional and the professional VC firms and private equity managed companies. So venture debt, therefore, going back to the original slide, is any form of debt capital that's available to companies after they've raised a Series A, though they may yet be burning cash and making losses. So what's the background? I mean, venture debt has been around in the US for the last 25 or 30 years. It's actually interesting to go back in history to understand the very first deal that happened. So my understanding is that this was a company called Seek Infotech, and this was, I think, the year 1980 or 1981. And there was a leasing company called Equitech Leasing that used to lease computers and high-tech equipment. And the private equity investors for Seek Infotech approached this leasing company and essentially asked them whether they could provide a lease to Seek Infotech, because they needed some capital equipment, to deliver against some contracts. The obvious sort of pushback was, on account of the fact that the company is still burning cash, and so Equitech effectively told the VCs involved that, look, if we need to do this, then we need to have an upside and a kicker, and we're willing to take the risk, but there needs to be an upside if the company does well, because this is a highly risky transaction. And so they got warrants in the deal. So they provided a loan, a leasing line of about $1 million is my understanding. And they had warrants on top of that, which gave the leasing company an upside if the company ever went out and got acquired or went through an IPO. Seek Infotech subsequently got acquired, and the leasing company not only got the lease back, but they made a significant upside on the warrant through the warrant, and that started the whole process of sort of the venture debt industry. And in 1981, there were not several, but there were a few banks and debt providers that started sort of selectively offering venture debt. That has subsequently grown as the venture capital industry has grown, as the lending model to those kinds of companies has gone through its sort of learning curve and has been strengthened each year. And as a result of that, today, venture debt accounts for 10 to 15% of the total venture capital investments annually in the US. So today in the US, I think in 2016, venture capital firms invested a total of $49 or $50 billion. And venture debt accounted for about 10 or 12% of that. What's also interesting to note here is the term venture debt is typically meant to be VC-backed companies or loans to VC-backed companies. And that's how most traditional venture debt players define venture debt. However, it's also subsequently now been expanded to include debt to any startup and high growth company, and not just those funded by VCs. The behavior there of borrowers, however, tends to be different. While traditional venture debt, which is VC-backed companies, have a 25, 30-year track record of sustainable returns, lending to early stage high growth companies, albeit without VC investors, is not that successful as yet. And so we still need to find a model of lending that works viably and successfully, aimed at borrowers who are companies that are not funded by VCs. So if you look at the typical venture debt terms, usually these are 3-year loans. I should say up to 3-year loans, and the typical sort of cookie cutter loan is a 3-year monthly repayment structure. In our history, though, we've had loans as short in tenor as 1 year, and in some cases, 1 or 2 cases, 6 months, and in the odd case, 60 months, 5 years. Really, it's every deal is different. And so when we select a transaction, it has to be tailored to the specific deal and the transaction, the dynamics of that transaction. And we'll get into, on a subsequent slide, on some of the factors that we look at when we evaluate what a borrowing candidate looks like. Loan amounts usually tend to range from $500,000 to $5 million. I've also seen venture debt deals at $20 million. But those are, in my opinion, more growth capital transactions underwritten to very different factors than how traditional venture debt is underwritten to. So I would say my definition, or the purest definition of venture debt, is something that's still in the range of between $500,000 and $5 million. Interest rates on those loans are intended to be priced at a point where a mid-market or a small and medium enterprise company would be able to borrow funding from the market. There is no established benchmark for this. It's significantly below, or perceived to be below, triple B or double B risk in many markets. And usually loans are priced depending on where, every market, of course, has its own pricing. And so in the US today, venture debt deals get, priced at somewhere between 5% and 10%, depending on who's lending. Larger banks like Silicon Valley Bank that have access to low cost of capital tend to be at the 5-6% range. Venture debt funds like WTI and Hercules and tend to be more at the 9 to 10, sometimes even 11 and 12% interest rates. In India, our market has typically had higher, the yield curve is much higher, and so we tend to do loans in the mid-teens, 14-15% at the moment. And then in addition to that, you get a small equity warrant, which is usually a cashless settlement warrant, which means you can, when it comes into the money and there's an exit, you can settle that for cash rather than having to exercise your option and buy the shares before you sell it to the seller. I'm sorry, to the buyer. Now, the whole idea between interest rate and the warrant component is typically for this risk, you would typically need to get paid as a lender somewhere between where traditional lenders make returns and where traditional venture capital investors make the returns. And so let's hypothetically set that at a mid-teens level. So let's say 15% is the expectation of the returns in this business from lending to this risky side, right? To this risky segment of companies. How that's typically done is, well, there's two ways of doing it. One is you price every loan at 15%, which then makes it expensive for the company because then the company needs to take care of interest payments monthly. The other way to do it is typically to break your return expectations or your IRR expectations into two components. The return that you expect to make from a fixed coupon on the interest rate and the returns you expect to make from the warrant. And therefore, you typically tend to get, let's say, 8% or 10% from your interest rate, and you expect to make another 5 to 6% from the warrant component in the long run on the portfolio basis. So let's say if you've made 100 loans, your expectation is that all of the 100 loans, except maybe the one or two that you end up writing off on, those 98 loans, you expect to get your principal back, you expect to get your interest rates back, and that interest rate, like I said, could be anywhere from 6 to 10% in that range. And then on a portfolio basis of the 100 loans where you get warrants, you expect perhaps 10 or 15 of them to give you some sort of returns back. And on a blended basis, you expect therefore to get to about a 15% interest, return on your capital. In India, the math is slightly different. We expect to get 15% interest back, and that's not unusual because AAA borrowers in India get access to term money at about 8% to 9%. So 15 is not exceedingly high. And then we expect to make another 5 or 10% on top of that through warrants, which gives us a return back of about, early 20s, I would say 20% plus. And of course, it also depends upon your cost of capital in the market. So India has a higher cost of capital. China is very similar. China is actually a little bit more variable. And I've seen interest rates in China go from 7% to 18%. It's a slightly different market with a number of players that operate through very different entity types, and there's a lot of inefficiencies in structures. And so pricing tends to be a little bit different and varied in China than it is in most other markets. Israel and Europe tend to be very much like the US. Israel perhaps slightly higher on the interest rates. Europe very much like the US in terms of interest rates and returns on the portfolio. The last 3 or 4 bullets on this slide really is some of the other aspects around the loan. So the loans typically come with lenders usually tend to get senior security. Now senior security over what? Over collateral. And what kind of assets and collateral would that be, right? So typically technology companies don't have a lot of hard assets, but they have a lot of IP. And IP actually can be very valuable for a lender if you know how to perfect your charge over it. And oftentimes it's the IP and the potential sale of the IP that can serve as a way to get your money back if the company goes into distress. Now, in the US, in Israel, and in Europe, companies tend to be more IP-based, more technology-based, and therefore there is the presence of IP in most cases that venture debt lenders can get a lien or a charge over. India and China tend to be markets where companies tend to be built more around a much wider canvas of business formats and business types. A lot of companies built around the domestic consumer demand in these 2 large markets. And therefore, companies tend not to be very tech focused. They tend to be more service oriented. and they tend to have this blend of sort of service-sized products and productized services, so to speak. And so the challenge for venture debt players in markets like India and China is that we need to learn to to kind of tweak the basic model of venture debt and get to the heart of what's unique and what's different about the company that you're lending to, and to ask yourself whether there's a way to secure your claim and to build a ring fence that uniqueness in some way that gives you the ability to control the conversation if the loan goes bad. And that's one of the interesting challenges we've had in India as we've sort of looked at growing this market over the last 10 or 12 years. There's also limited financial covenants that we lay on early stage companies because there's no real metric you're going to ask companies to jump over in terms of hurdles. And so we tend not to have those. There's also no restrictions on end use and no personal guarantees from the founders, which are both very different from how traditional banks look at it. So banks will almost always ask personal guarantees from the founders, at least in India and China. And will certainly have restrictions on what that loan can be used for. Our intention is to provide the capital to companies to free up their arms and to use it as they will for growing their business, recognizing at all times that the companies understand a lot more about their own business than we are ever going to know. And so the intention is to give them capital which enables them to grow their business and not restrict that in any manner. So let's look at some of the typical use cases for venture debt. The first and the most, the one that's the most obvious is that it really helps extend runway between rounds. Now, if you recall from one of the first initial slides where I showed the life cycle, you have Series A and Series B and Series C and so on. When a company raises a Series A, it raises the money with the expectation that it will need, let's say, 12 months to hit the next set of milestones. And by hitting those milestones, the company then can get significantly more valuable and therefore be in a great position to raise Series B at a much higher valuation for a much larger round of capital. Now, as it happens in the world of startups, one tends to underestimate the amount of time, effort, and capital that you actually need to hit those milestones. You may actually realize that you need 15 months and not 12 months to hit your milestones. Or you may realize you need 12 million and not 10 million to hit those milestones. Clients take longer to sign contracts, products take longer to develop, and so on. And so what venture debt does is essentially it sits alongside the equity that you've raised from an equity investor and gives you some additional capital to play with so that you have an extra time to hit your milestones. And so if the company has raised, let's say, a $5 million round of equity, through venture debt, it can raise 1 million additional money at significantly less dilution than raising that one through equity would have been, and therefore raise a total of 6 million with the dilution of just 5 million. And of course, some dilution that you have to account for through the warrants and the interest rate. Hypothetically, if we were to do a loan at, let's say, 10% and take warrants for another equivalent of another 5%, that's, let's say, just crazy maths. Let's just say it's 15% dilution on account of the loan. Essentially, what you're doing by taking 5 of equity and 1 of debt is you're raising 6 of total capital, but you're diluting 5.15 million worth of ownership in the company. And so that's how debt essentially helps companies to raise additional capital without diluting as much. So think of it as insurance, right? I mean, you buy insurance along with your equity round by taking some debt, and that insurance essentially gives you, if you don't need it and you actually hit your milestones in time, great. But if you don't hit your milestones in time, then the venture debt essentially gives you 3 or 4 months of additional liquidity within which to hit your milestones. So I've actually got a case study a couple of slides down which shows exactly how this was achieved by one of our first clients in India, in fact. And we'll get to that in a couple of slides. The second use case really is for working capital financing. That's, now, Generally, one thing that startups tend not to do too well is actually collect. And they push sales, but they are relatively quite poor at collecting. And debt actually helps them to finance the cash, the working capital cycle. Uh, it does one more thing, which is it instills a sense of discipline in companies. And there's a lot of times that VCs have called us into their companies, not because they need the capital per se, but because the VC believes that the company will be held to a higher level of diligence if they have a loan obligation that they need to keep tracking every month. The third is really fixed asset purchases. This also works in certain markets like in India, where banks are not permitted by regulations to finance acquisitions. So in other markets, banks are perhaps allowed to. In India, if a company is acquiring another company, they cannot use bank financing to do it. And so they've had little alternative in the past but to raise equity capital to make acquisitions happen, or to buy through shares. And what venture debt in our market has done is essentially allowed a lot of these companies to go out and buy other companies for cash, and thereby make a stronger and a better offer to buy out. Optimized dilution is actually linked to the first point that I mentioned, which is debt. The capital that we provide, because it is structured as debt and not equity, translates into some solid equity savings for the companies involved. So the benefits here, as I mentioned, it's really helps the company access more capital, extends cash runway, minimizes dilution, and the fourth point here is actually something that's also interesting, which is tangential benefits of staying power. When a company goes into a fundraise, a Series B or a Series C, a subsequent fundraise, there's a significant disadvantage to showing the incoming investors that they desperately need money. And so having this additional sort of war chest of capital from the venture debt round actually helps them to make sure that they don't rush into negotiation and take their time closing the next round. So it has different benefits as well, rather than the traditional ones of saving dilution and extending cash flow runway. So when does it make sense to not take it, right? And before we get to when it should not be taken, the left box really is about when to raise venture debt. And therefore, the best time to raise venture debt is along with an equity round and just after an equity round. Because that's when the company has the most amount of cash. It's able to therefore be the safest time for a lender to look at it, and therefore will get the advantage of the best possible terms that a lender can provide. Now remember that the average time between rounds, an equity round, for a company is hypothetically, let's say 12 to 18 months. Our loans go up to 3 years and more. And so you're always looking for, as a company, you're looking to take capital when it's available and when it can stretch out the most for you. In an ideal world, a company should look to raise debt or any form of capital really right at the time only when it needs it. And that's kind of like buying insurance when you're already on the way to the hospital, right? That's when you're going to get the worst possible terms, because it's the most risky time for a lender to lend. And so when a company has a Series A or Series B round, that's the best time to raise it, because that's when the company has the cash, when the investors are what I would say the most optimistic, when they're able to stand up and defend their companies, when all of the diligence materials are fresh and readily available. And more importantly, it's a time when the valuation for the company has just been set. And that's important because our warrants get carried, the strike price in the warrants tends to be linked to the round at which the company most recently issued shares. And so at that point, the valuation of the company is just fresh, and it's easy for the investors and the company to give us warrants at that same price. The further away from the round we do, the more like a bridge it seems, and the more risky it gets. And therefore, price and terms tend to get more stiff. And so the right box really talks about some of the scenarios in which debt could actually be harmful for the company. And one of those is when the borrower has a binary element to its business outcome. And this could be situations where the business really rests on getting a certain license, let's say, or certain specific approvals. And not getting those approvals could essentially make the company's product obsolete. That's not a good time to take debt because it's a binary outcome, and if the company is not able to get onto the positive side of that, there's a huge debt obligation that needs to be managed. The second one is more a rule of thumb where debt servicing should not account for more than 20% of the borrower's monthly operating costs. And that's just good practice, and that's something that we've seen from our own experience, that it should actually not be a big chunk of the company's operating cash, because otherwise it tends to burden down the company rather than create cash for them to run their business. And the third is the one I mentioned earlier, which is a bridge loan situation when the borrower is running out of money. At that point, the odds that the company will either take much longer than expected to close an equity round or never complete an equity round, the odds of that happening tend to go up. And that's when lenders get nervous because they're not sure about whether the repayment will happen or whether it will go into distress 6 months from making the loan. And so the terms tend not to be very favorable at that stage. So most times, companies can benefit from debt because obviously debt is cheaper than equity. And so using some debt along with capital, with equity capital is great. But there are times when a company should not take the debt. And these are situations when we actually push back. And we've had, I'd say, for every deal that we've done, we've probably rejected about 3 or 4 of them. So this is the case study that I referred to. This is actually one of our first clients in India. This was an ATM company funded by a large Silicon Valley investor. And at that stage, the company had raised an equity round of $4 million through a Series A. Now, the left box there describes how the company was burning through cash every month. And the red bars indicate the cash burn, the total burn that the company had every month. So, for example, it burned a little bit about $1 million in total burn in the first month of February 08. And that stepped up a little bit as the company's operations grew. But because revenue still had to kick in any meaningful amount, it was burning cash of a couple of $100,000 a month. And therefore, the equity of $4 million gave it a runway through April of 09, and it was expected to run out of cash in April 09. The middle bars, the taller ones that you see there, starting from about December 08 through about April of 09, were higher than the rest in a spike because the company had to spend about $1 million in getting a platform built, which was to be the settlement platform for the product. And that essentially accelerated the burn. So you see the little bit of an inflection point in the blue line on the left box starting from about November of 08. And in any case, the company was expected to run out of cash by April 09. We provided a venture loan in November 08, actually December 08. And that essentially gave the company an additional 4 months of runway. And that gave it more time till August 9. So the company actually raised its Series B of another $10 million in June 09. And if we hadn't given them that venture debt line of $1 million, the company would have run out of capital in April 2009, and instead had this additional 4 months during which they actually could manage to they could show that the platform was in place, thereby improving their valuation. So that was their milestone that they needed to achieve. So the venture debt line helped them get 4 months more, which they used to build up their platform, show that they could do it, hit a very important milestone, and therefore raise a much larger round of capital at, I think it was a 4x valuation jump from there on. The other slide that I have with this, basically I didn't include that for want of time, was where it showed that the dilution saving that the company gained from taking venture debt, and if they had taken the $1 million from another equity investor, and instead they took it as debt. If they had taken that as equity, they would have lost. Let me rephrase that. Instead of taking the $1 million as equity, the dilution that they saved by taking the $1 million in debt actually was $20 million. And that $20 million was the gain to the promoters when they sold their company 5 years later. So there's real benefits to taking venture debt in addition to the immediate one of sort of pushing out your cash flows. So how do we, the next few slides, the 3 slides are really on how do we look at, as lenders look at companies, and why does venture debt, why is that such a compelling proposition for us in the marketplace? And this is sort of a very broad thematic of how we select our companies. The first and most important qualifier here is it backed by a top-tier venture capital firm? The presence of a top-tier VC in the company does multiple things for us as lenders. First of all, it provides a strong layer of equity in the company. It provides us with an investor who's present at the board, who can give us honest and unbiased feedback on how the company is doing. It gives us an important lever of conversation when the company goes sideways. It actually also provides a follow-on round of capital. So most investors will reserve a certain portion of the capital for follow-on investments. And so for us, not all investors are built equal. Not all capital is as green. We tend to have our own sort of filter of which VC firms make the cut. We exclusively work with those VCs and those VCs only. And interestingly, even within VC firms, there may be certain partners that we partner with and other partners that we don't like. And we tend not to fund those partners' deals. There's also companies that, we need to make sure the company has strong enterprise value. Now, enterprise value is a very vaporous concept. It's basically how we look at the value of the company over and above its hard assets. It's looking at things like IP. It looks at brand. It looks at how is the company positioned. What's truly the liquidation value of this company if we had to liquidate it today? Most times, the companies we lend to have valuations which are, I would say, 20 to 30 times of the quantum of loan that we provide. So if we provide $1 million loan, in most cases, the company's valuation would be $20 or $30 million. And that gives us some comfort knowing that the company has value, which can be monetized in the event that the company goes sideways and our loan needs to be extracted. We look at a recent round of VC financing. As I mentioned earlier, the closer to the VC round, the better for us. That's when the VC and the company are, for want of a better way to describe it, are in love with each other. And that works well for us because we know that the VC will do anything and everything that they can do to keep this company afloat and help it navigate through its sort of minefield of growth. The next point is we look at a solid senior security position. Most cases, we are the first lender into a company. We tend to take a blanket lien over the company's assets. And therefore, we need to make sure that we're in control of the conversation when things go sideways, if they do, on loans at certain points. And the last concept there really is the team, because ideas are great, but they're only as valuable as the teams are, and as valuable as execution is. And so we also place a lot of reliance and emphasis on the team to get to the heart of sort of the companies that we lend to. The one important distinction, and this sounds a lot like what VCs would do, the key point of difference between what venture capital investors do and what venture debt providers do is that VC investors are paid to look at upside potential of a company. Debt providers, on the other hand, like us, are paid to look at downside protection. And so we might look at a company and not expect it to be the next Google or the Facebook, but we do expect the company to have sufficiently exciting things happening in it that we think that the company can raise its next round within the next 12 or 18 months and therefore keep our loan position safe. And of course, if the company does well, then we benefit through our warrant position. So venture debt compared to other forms of capital, it's got, it's much better in terms of returns than mezz and senior leverage debt, as I mentioned. It also has better security downside protection compared to venture capital and mezz. So it's in our estimates, it's placed really sweetly where you get a great combination of downside protection and upside opportunity. And how that happens is actually on the next page, which is where I've compared venture debt to venture capital. And if you look at the way that the options play out, in a successful exit, a VC gets capital and significant equity gain. A venture debt provider in a successful exit gets the capital and the interest back and the equity gain, some part of it. Now, to put this in context, the ATM company that I referred to in the case study, that was $1 million loan that gave us 13% interest back over 3 years. We had on that $1 million loan a $200,000 warrant. That $200,000 warrant gave us a $2 million upside. So $1 million loan gave us in total $2 million of equity upside and 13% interest back. And that's what this graph, this box here shows. In a break-even environment, we still get our interest back. And in a loss, we have the potential for the security or the IP or the other unique factor that we have that we can potentially sell to another investor or another company and extract ourselves out of it, and then some interest comes back. Most loans, when they go bad, tend to go bad after the first year or a year and a half. And so at the very least, if you've got a 36-month loan structure, you can expect to get, let's say, 50% of that back in 18 months. So even if a company has to fail, we generally get something back in terms of capital and interest, and then hopefully we make the remaining part back through the security interest. So that's all I had. Happy to take any questions, Christy.
Excellent. Thank you so much, Ajay. One question that did come through just a minute ago. At what point does a company decide to go into Series C, D, E, etc., first getting acquired versus IPO? So if a company gets acquired or goes public, how does this affect venture debt?
It doesn't affect venture debt because the warrants are typically, so our warrants typically tend to be 7-8 year options, and our loans are sort of 3-year loans. Most companies that do tend to get acquired, you don't need to go through Series C, Series D, Series E. They could well be acquired right after Series A or Series B. So I'll give an example. I mean, one of the companies that we exited out called Carvali, actually, we did the loan in June of 2009, and we got an exit on our warrant in December 2009. And that was while our loan was still, 6 months old, and our warrant was, also 6 months old, obviously. But the most cases that we've seen, the other deals, and that's obviously an exception, but most cases we've seen companies tend to get acquired somewhere between sort of 3 and 6 years or 5 years of starting out with the Series A, at which point the loan has usually been repaid, but the warrant continues to be outstanding. So I don't know if I've answered the question.
No, that's very helpful, Ajay. And another question, too, that has come through, what would you say are some of the best resources to learn more about when choosing venture funding and alternative capital sources?
How I understand that question is, what are the things that you should be aware of when trying to decide between the various forms of capital, whether it's venture capital or other forms of capital. And to me, it seems though, look, I think for us, equity and debt both have their advantages. Equity is obviously longer term, more patient capital, and it's needed for some of the things that don't give you returns back immediately. So, R&D, for example, is a great example of where equity should be used because it's long term, it's more patient. Whereas there are more tactical reasons to use debt for shorter term things, asset acquisitions or working capital. And those are things that are fairly wasteful to use equity for. and those are things that you should use debt for. So I think that the choice depends upon kind of what you're using, what you're using the money for. And of course, it also depends upon, what stage of growth your company is at. Because when you're starting out at a Series A stage, you're not going to find lenders that are going to, sort of offer capital to you if you don't have the equity raised. It's unlikely that you would find any interest from a lender or leasing company at that stage. And so once, I think the first round of capital, serious money, in my opinion at least, should be equity. And once you've raised equity and you've given yourself a little bit of room to maneuver, then I think you should consider the other alternatives that exist out there, whether it's leasing or venture debt. At later stages, as the company sort of goes on through its life cycle, and it's approaching a point where it's beginning to break even. At that point, you have more traditional forms of borrowings that become available. First as working capital short term, and then gradually as banks get more comfortable, gradually more long-term capital. And in between, there are asset-based lenders that can give you funding against ARs and against inventory and so on. But at the initial outset, I think your options are more limited. My recommendation is when a company wants to look at serious growth, it should take the capital, preferably from an equity provider and preferably a VC, because they're the ones that can provide capital relatively at the first several stages of the company's growth, from Series A through Series C.
That's great, Ajay. Thank you so much for all this helpful information. Another question, too, that an attendee submitted, they would be interested in knowing what venture capital can help besides funding, and how to choose venture capital that is supportive while not being too much of a control freak, they said.
So, every VC firm has its own model. There are more sort of simple VC models where they provide value through capital, and that's it. There are other VC firms that play a more platform approach and provide access and help through many other functional areas. So you might have VC firms that have recruitment or HR specialists. You might have people that help on marketing. Now, all of these services obviously will come at a premium. And the premium here is basically a demand for valuation, which is more skewed towards them. And so, one of the decisions that founders need to make is how much they really want to rely on VCs for help. And does it make sense to go with a platform, a VC that offers a platform, if really all they want is capital and they have several, let's say, large angels on their board that can make superior contacts to them? Or do they need, and are they willing to pay a premium to bring in a large VC with a platform? If that's what they want, then that's what they should look at. The question of control freak is, yeah, I mean, it's tough, and I think you just have to do your homework on that one and make sure that the investors that you're getting into bed with, you've vetted them out, you've scoped them out, you know what they do. It's never an easy decision, right? Because it's a very hard and time-consuming process when you go fundraising, and oftentimes the first offer that you get is the one that many people tend to settle for without doing a lot more homework. So I think doing your homework and knowing who your VC is and where you're getting your capital from is critical to the process. So just make sure that, and it's you're getting sort of you're getting joined to the hip for the next 5-6 years. So it's an important decision that you need to make. That's all I can say. Just do your research.
All right, thank you, Ajay. Another question: what would you say are some examples of funders that provide venture debt in the U.S.?
So there are broadly two types. One are banks like Silicon Valley Bank and Square One Bank, which are essentially banks that specialize in entrepreneur funding and do venture debt. And I myself started out with Silicon Valley Bank, and I started the India business, which subsequently morphed into Innovent Capital after our buyout 3 years back. So I can vouch for Silicon Valley Bank. I think they're a great organization. There's a number of things that they do in addition to funding that really help founders, right from the time that they have a business plan idea and they're looking for a bank that really understands them. So I'd say Silicon Valley Bank is a full stack relationship bank that looks at the entrepreneur segment, does venture debt. It's, to me, the 800-pound gorilla of the business. The other construct is our pure play venture debt funds that are set up like venture capital funds. And there are funds like WTI, there's Triple Point, there's Hercules. So there's a number of funds. I think it's at a point today where there's a lot of capital available. The difference between banks and venture debt funds, there are sort of pros and cons to both. Banks tend to provide a more holistic platform for the founder, and they provide a range of banking services as well. And they'd like to kind of do more with the company as the company grows and through multiple different products. So as the company matures, Silicon Valley Bank, for example, can flip from being provider of venture debt to being growth capital to being asset-backed loans and corporate finance and so on. And they also have a relatively much lower cost of capital compared to funds, and therefore they tend to be more cost-effective when it comes to borrowing. The advantage in favor of funds, however, is that their deal sizes are much larger, and they can step up for much larger rounds of venture debt. So I've often seen term sheets of $5 and $10 million from venture debt funds, whereas SVB might sometimes be restricted in doing initial venture debt of up to $3 or $5 million. So I think there's lots of capital available today. Most VCs will usually refer their companies to a venture debt provider, and most VCs tend to have their preferred sort of partner that they've worked with over the years.
Great, thank you, Ajay. Just another question, can you expand a little bit more on where you can go to learn more about this area, venture cap versus venture debt versus other financing?
Well, there's actually a lot of research. I mean, there is Harvard Business School studies case. There's some case studies on Silicon Valley Bank and on venture debt. There's also a Wisconsin business case study on venture debt from a more academic standpoint, actually. But there's a lot of research available on websites today on venture capital and venture debt. Our own website, Innovent Capital, has a lot of data. But actually, it's not very hard. I mean, look, when I started doing venture debt in 2005, I started the model really based on just my research, because I had no one to kind of teach me about venture debt in India. I was at Citibank, which is about as far away from venture debt as possible. And my initial model that I built was built purely on doing research, just Google stuff and find out stuff. And actually, what is surprising to me is that the model that I had developed for 2 years while I was at Citi was very, very close to the model that I learned Silicon Valley Bank did when I joined Silicon Valley Bank in 2 years later. So there is a lot of data, a lot of information available.
Wonderful. And just a final question for today, how is venture debt different than mezz debt?
So mezz is typically, I guess in some ways you could say venture debt is like mezz debt. Now we're getting into a little bit of a definitional thing and we're splitting hairs here, but mezz debt to me is where you take subordinated positions, where you might extend capital without any collateral or inferior subordinated security. Your returns there are expected to be more equity-like, and you're taking more naked risk on the company. Venture debt, actually is much more secured, though it looks crazy when you actually lend to a startup company that's burning cash. the perception that again, it's down to a perception issue. So mezz debt usually is to more mature companies that have cash flow, whereas venture debt is more to early stage cash burning companies. And it actually venture debt looks like an absolutely insane business to be doing as a lender. But when you understand how VCs fund companies and help them navigate through growth, and they're willing to support them, you actually realize that venture debt is a far safer business than mezz debt is, because you have an extra pipeline of capital that comes into these companies in the form of subsequent equity rounds, which companies that take mezz debt generally don't have. So mezz is just generally described for companies that are much more mature with cash flows, and you may be subordinated to other lenders. Whereas venture debt, you're generally the senior most lender, and you're not subordinated. You actually have a superior charge to even the equity holders in the business.
Excellent. Thank you so much, Ajay. Just on behalf of the UB Alumni Association and the UB School of Management, I would like to thank Ajay again for sharing his time, knowledge, and expertise with all of us. This webinar has been recorded, and we will send you all the link within the next 24 hours. We also want you to please save the date for Wednesday, June 7th, as UB alumnus and former CIA officer Mark Purest will share with us what's included in due diligence for business or litigation, as well as a few Google Ninja tricks. We will share additional details and the registration link in our follow-up communication. And then in addition, we do have some upcoming webinars in the month of June on the following topics. We're going to have an alum talk about the art of persuasion and sales in life, as well as someone speak to us a little bit more about professionalism in the informational interview process. So with that said, a big thank you to Ajay, really on behalf of the UB Alumni Association and School of Management. Thank you again, Ajay, and we hope you all enjoy the rest of your day.
Thank you. My pleasure. Bye.
Thank you.